It's a Tuesday afternoon in November 2022. The cryptocurrency world is about to witness the most spectacular collapse in its history. A man sits in his penthouse apartment in the Bahamas, scrolling through his phone as frantic messages flood in from around the globe. His exchange, once valued at $32 billion, is hemorrhaging money faster than anyone thought possible. Within hours, billions of dollars in customer funds will simply vanish. This isn't just another crypto crash. This is the story of how one of the world's most trusted cryptocurrency platforms became the center of the largest financial fraud in modern history. The man's name is Sam Bankman-Fried, and he's about to become the most wanted person in the digital currency world. What started as a revolutionary trading platform that promised to democratize finance has become a house of cards built on lies, manipulation, and stolen customer money. By the time this story ends, thousands of investors will lose their life savings. Regulators will scramble to understand what went wrong, and the entire cryptocurrency industry will be left questioning everything they thought they knew about digital assets. But to understand how we got here, we need to go back to the beginning. Back to when Sam Bankman-Fried was just another ambitious college graduate with big dreams and an even bigger appetite for risk. The year is 2017, and cryptocurrency is entering its first major boom cycle. Bitcoin is soaring toward $20,000, and everyone wants a piece of the action. Traditional Wall Street firms are scrambling to understand this new digital frontier, while tech-savvy entrepreneurs are racing to build the infrastructure that will power the future of money. Sam Bankman-Fried seems like the perfect person to bridge these two worlds. He's got the credentials that Wall Street respects. He graduated from MIT with a degree in physics and immediately landed a job at Jane Street Capital, one of the most prestigious quantitative trading firms in the world. He's making serious money, the kind that most people his age can only dream of. But Sam isn't satisfied with just being another successful trader. He's got bigger plans. The cryptocurrency markets are wild and inefficient. Price differences between exchanges can be massive, sometimes varying by thousands of dollars for the same digital asset. For someone with Sam's background in quantitative trading, these inefficiencies represent pure opportunity. While other traders are fighting over fractions of a percent in traditional markets, crypto offers spreads that seem almost too good to be true. So in 2017, Sam makes a decision that will change everything. He quits his comfortable job at Jane Street and starts his own trading firm focused exclusively on cryptocurrency. He calls it Alameda Research, named after a street in Berkeley where he once lived. The plan is simple. Use sophisticated algorithms and massive amounts of capital to profit from the chaos in crypto markets. Buy low on one exchange, sell high on another, and pocket the difference. It's called arbitrage. And in traditional markets, opportunities like this disappear within milliseconds. But in crypto, they can last for hours or even days. The strategy works better than anyone could have imagined. Within months, Alameda Research is generating millions of dollars in profits. Sam and his small team of traders are making more money than they know what to do with. They're working around the clock, sleeping in shifts, and living off energy drinks and takeout food. The office feels more like a tech startup than a traditional trading firm, with beanbags instead of boardroom tables and casual clothes instead of suits. But Sam quickly realizes that making money in crypto isn't just about finding arbitrage opportunities. The real challenge is moving that money around efficiently. Traditional banks don't want to deal with cryptocurrency businesses. Wire transfers take days to clear. Foreign exchange rates add another layer of complexity. And every delay costs money in a market that never sleeps. What Sam needs is his own exchange, a platform where he can trade without relying on other companies' infrastructure, where he can set his own rules and move money at the speed of light. The idea starts as a way to make Alameda Research more efficient, but it quickly becomes something much bigger. In 2019, Sam launches FTX, positioning it as the exchange built by traders, for traders. From the very beginning, FTX is different from its competitors. While other exchanges focus on basic spot trading, FTX offers sophisticated derivatives, futures contracts, and leveraged products that appeal to professional traders. The platform is fast, reliable, and packed with features that most retail investors don't even understand, but that's exactly the point. Sam isn't trying to compete with Coinbase for casual investors. He's building a platform for the professionals who move serious money. The timing couldn't be better. As 2019 turns into 2020, the cryptocurrency market is about to enter its most explosive growth phase ever. Institutional investors are finally starting to take digital assets seriously. Companies like Tesla and MicroStrategy are adding Bitcoin to their balance sheets. Even traditional banks are scrambling to offer crypto services to their clients, and FTX is perfectly positioned to capitalize on this institutional wave. The numbers are staggering. FTX processes billions of dollars in trading volume every single day. Revenue is growing exponentially. The company raises money from top-tier venture capital firms at valuations that seem to increase with every funding round. Sam becomes one of the richest people in the world, with a net worth that peaks at over $20 billion. He's featured on magazine covers, speaks at major conferences, and becomes the face of the cryptocurrency revolution. But success brings scrutiny, and scrutiny reveals cracks in the foundation. While FTX is growing at breakneck speed, the relationship between the exchange and Alameda Research is becoming increasingly complex. On paper, they're separate companies with separate management teams. In reality, the lines between them are blurring in ways that should concern anyone paying attention. The first red flag comes from FTX's terms of service. Buried in the legal fine print is a clause that allows the exchange to lend customer funds to affiliated trading firms. Most users never read these terms, and even fewer understand their implications. But this single paragraph gives Sam the legal cover he needs to move money between FTX and Alameda Research whenever he wants. The second red flag is more subtle but equally important. FTX creates its own token, called FTT, which customers can use to pay trading fees and access special features. But the majority of FTT tokens are held by Alameda Research, creating a circular relationship where Sam's trading firm owns a huge stake in his exchange's native currency. When FTT's price goes up, Alameda's balance sheet looks healthier. When Alameda needs cash, it can sell FTT tokens to raise funds. This interconnected web of relationships works perfectly, as long as everything is going up. FTX's trading volume is exploding, FTT tokens are appreciating in value, and Alameda Research is generating consistent profits. Sam looks like a genius who has built a vertically integrated cryptocurrency empire. But empires built on leverage and interconnected risks have a tendency to collapse when conditions change. The third red flag emerges from the culture Sam creates around his companies. FTX and Alameda Research operate more like a college dorm than a financial institution. Employees live together in shared apartments in the Bahamas. They play video games during work hours, take amphetamines to stay alert during all-night trading sessions, and make million-dollar decisions based on gut feelings rather than rigorous analysis. The casual atmosphere attracts young, talented programmers and traders, but it also creates an environment where normal risk management practices are treated as obstacles to innovation. Sam presents himself as a different kind of billionaire. He drives a modest Toyota Corolla, wears cheap t-shirts and cargo shorts, and pledges to give away the majority of his wealth to effective altruism causes. This image of the reluctant billionaire who cares more about saving the world than making money resonates with a generation of investors who are skeptical of traditional Wall Street culture. The media loves the story of the young genius who is revolutionizing finance while living like a college student. Sam becomes a regular guest on financial news shows, where he explains complex trading strategies with the enthusiasm of someone discussing their favorite video game. He testifies before Congress about cryptocurrency regulation, positioning himself as the responsible adult in an industry full of scammers and speculators. But behind the scenes, the pressure is building. As FTX grows larger, it attracts more sophisticated competitors and faces increasing regulatory scrutiny. The easy arbitrage opportunities that made Alameda Research so profitable in the early days are disappearing as the market becomes more efficient. Sam needs to find new ways to generate the massive returns that his investors and customers expect. The solution he chooses will ultimately destroy everything he has built, but in late 2021, it seems like the obvious next step in his plan for crypto domination. The solution involves taking bigger and bigger risks with customer money. What starts as temporary loans between FTX and Alameda Research gradually becomes a permanent feature of how both companies operate. When Alameda needs cash for a particularly large trade, Sam simply moves funds from FTX customer accounts. When FTX needs to show healthy reserves during investor meetings, money flows back from Alameda to cover the gaps. This system works perfectly until it doesn't. The cryptocurrency market begins to shift in early 2022. Bitcoin starts falling from its all-time highs. Institutional investors who rushed into crypto during the boom begin pulling their money out. Trading volumes on FTX decline steadily as retail investors lose interest in digital assets. The fees and revenue that once seemed guaranteed start drying up. But Sam has a much bigger problem than declining revenue. Alameda Research has been making increasingly desperate bets to maintain its track record of outsized returns. The firm has borrowed billions of dollars to invest in illiquid tokens and risky ventures. When these investments start losing value, Alameda needs more and more cash to meet margin calls and avoid forced liquidations. The amount of customer money flowing from FTX to Alameda Research grows from millions to billions of dollars. Sam tells himself this is temporary, that one big win will allow him to pay everything back with interest. But the wins don't come. Instead, each failed trade requires even more customer funds to cover the losses. By the summer of 2022, Sam is trapped in a cycle that can only end in disaster. FTX customers believe their money is sitting safely in segregated accounts, but the reality is that billions of dollars have been gambled away on high-risk trades that went wrong. Sam continues to make public appearances, speaking confidently about FTX's financial strength while privately scrambling to find new sources of funding. The beginning of the end comes from an unexpected source. In November 2022, a leaked balance sheet from Alameda Research reveals that the trading firm's assets consist primarily of FTT tokens and other illiquid investments. The document suggests that Alameda is essentially broke, surviving only because of its relationship with FTX. When news of the balance sheet leak spreads through crypto circles, it triggers a cascade of events that Sam cannot control. Changpeng Zhao, the CEO of Binance and Sam's biggest competitor, announces that his exchange will sell its massive holdings of FTT tokens. This creates immediate selling pressure on FTT, which crashes the token's price and destroys Alameda's balance sheet overnight. But the real crisis begins when FTX customers start demanding their money back. What should be a routine withdrawal process becomes impossible because the money simply isn't there. Sam has been using customer deposits to prop up Alameda Research for so long that FTX doesn't have enough liquid assets to meet withdrawal requests. The situation deteriorates with breathtaking speed. Within days, FTX goes from being valued at $32 billion to filing for bankruptcy. Customer withdrawals are frozen, leaving millions of people unable to access their funds. Sam resigns as CEO and flees to the Bahamas, where he gives a series of disastrous interviews claiming that everything that happened was an accident. The investigation that follows reveals the full scope of the fraud. Prosecutors discover that Sam and his inner circle treated customer funds as their personal piggy bank, spending billions on everything from luxury real estate to political donations. The missing money isn't just the result of bad trades, it's the result of deliberate theft on a massive scale. When the dust settles, over $8 billion in customer funds cannot be accounted for. Thousands of individual investors lose their life savings. Institutional clients who trusted FTX with their corporate treasuries face massive losses. The ripple effects spread throughout the cryptocurrency industry, causing other firms to collapse and destroying public confidence in digital assets. Sam Bankman-Fried, the young genius who promised to revolutionize finance, is arrested in the Bahamas and extradited to the United States to face federal charges. The trial that follows exposes the culture of reckless risk-taking and casual fraud that characterized his companies from the very beginning. The FTX collapse becomes a cautionary tale about the dangers of unregulated financial markets and the importance of proper oversight. It shows how quickly trust can be destroyed and how devastating the consequences can be when that trust is betrayed. The billions of dollars that vanished represent more than just numbers on a screen. They represent the dreams and futures of real people who believed in the promise of cryptocurrency. In the end, Sam's story serves as a reminder that in finance, as in life, there are no shortcuts to success. The technologies may be new, but the fundamental principles of honesty, transparency, and fiduciary responsibility remain as important as ever. The billion-dollar Bitcoin bust didn't happen because cryptocurrency is inherently flawed. It happened because the people running these systems forgot that other people's money isn't a toy to be played with. The cryptocurrency industry will recover from this scandal, but the lessons learned from FTX's collapse will shape how digital assets are regulated and traded for generations to come. Sometimes the most expensive education comes from watching someone else's spectacular failure.